heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we break down Disney's results as the media giant takes a hit amid the battle for streaming dominance.
Plus, we'll bring you my conversations from Google I/O and hear from the SAP CEO as the companies team up with Google Cloud to maximize AI usage.
And Microsoft announcing it's freezing salaries this year as the tech giant looks to navigate economic uncertainty. We'll bring you the details. So much more this hour, and the market, too, is trying to navigate economic uncertainty at the moment. Worries about the debt ceiling, worries about the ongoing concerns around US banks, and yet tech, it outperforms. We're up only 0.1%, but managed to shake off some of the nerves in the rest of the market at the moment. We're up just some 15 points. Now, there was economic data that the jobless claim showed some worry about the slowing in the jobs market. Inflationary pressure dialing back a little bit when it comes to producer prices. The two-year yield is coming down on that perhaps fall down in the inflationary pressure. But does this mean some sort of recessionary environment? That is probably the watchword for today. We're looking at KBW Bank Index under pressure with, of course, PacWest, the one that we look at front and center. Let's dial it on. Let's look at what's happening in terms of the desire to get into a haven means the dollar is going higher. It means crypto is going lower, off by 2.5%. So Bitcoin currently trading at 27,000 on the day, Ed. But go into some of the micro, the earnings and the like.
Yeah, actually, outside of earnings, there's quite a lot of news flow that's driving these movers. Peloton, a recall of 2.2 million bikes. We're going to get into that late in the show with Bloomberg's Mark Gurman. But at one point in the session, that stock at a record low. It's having an impact. Alphabet, parent of Google, up significantly, 5%. Biggest jump since the first week of February. It's trading at an August high. The market liked what it heard about what they're doing in the field of AI, and we will hear more about that as well. Interesting that some of its peers in the AI space, Microsoft and Nvidia, are a little softer. Both of them down around 0.8%. Disney is the big mover to the downside, and that one is on earnings. A miss on subscribers and profit in the current period. A loss will be wider or widening from the past quarter. It's interesting because they're still on track to meet that cost reduction goal, but there are some worrying signs about the cost of streaming. It's streaming or nothing. So let's stick with Disney and bring in Bloomberg's Chris Palmieri from LA. That subscriber miss, Chris, was quite interesting because it seems to be showing the impact of bringing in an ad-supported tier in the quarter gone.
Right. I mean, some people would argue a cheaper ad-supported tier would bring in new subscribers, but Disney now for the second quarter has lost Disney Plus subscribers overall. That's partly with when they introduced the new tier, they really raised the cost of the ad-free version 38%. And so I think you're definitely seeing some people canceled for that reason. And there's concern now, have we peaked in streaming penetration? That obviously is worrisome.
Christy McCarthy, the CFO, though, trying to cast this as a blip when it comes to increased spending from a marketing perspective, Chris. Why aren't investors sort of seeing it as that?
Well, you know, that's the thing is that there's been so much focus in the last few months, less on subscriber growth in these companies and more on let's wring profits from this. But now this seems to be now a focus on both as well. It's going to be difficult. There was a lot of things on the call to ponder. Suggestions, for example, that Iger now likes the Hulu streaming service, wants to keep that. And that, which means they'll have to buy out the 1/3 of Hulu that they don't own. There's also a big write-off on content that they're no longer putting on the services. So at the same time, they're talking about raising the cost of the Disney Plus service. They're reducing the programming on it. So there's a lot of uncertainty in streaming right now.
And also, I mean, the people who've left from the streaming unit as well. The fact that all at the same time they are thinking about costs, they are cutting into their labor, into their talent pool, and a lot of that comes from the people who actually launched Disney Plus, right?
Right, and you know, overall, we're in the midst. Disney's in the midst of a 7,000 person reduction, hoping to save $5.5 billion in costs. You know, this was not the maximum quarter for that. It'll be the current one where a lot of the people were let go. But there wasn't a lot of discussion. They said they're on progress to meet those targets, but not a lot of discussion about how much they're really saving, and we'll see this year. So that's another concern.
The discussion across Bloomberg Television and radio all morning is whether Disney is a technology company or if it's a media and entertainment company. And it's interesting, the bright spot, Chris, the parks business. Technology company that operates a parks business?
Well, they would certainly like to think that they're technologically savvy. You know, they have all these, you can order online. Everything's, through your app nowadays. You pay a little extra through the app and you can cut in line on the rides. So there's a whole lot going on there. But yeah, but basically this is an experiential business. It's certainly in the future, we'll all be watching things online. But it depends on, really human interaction to make those great movies and TV shows work. So, I would put Disney in the media and entertainment category more than tech. And
Chris, did they mention AI?
Yes, there was a discussion of that, and I don't think that there seems to be agreement in Hollywood that this is not going to completely replace the screenwriter, and so we'll see how that plays out in negotiations with the writers' strike, because the writers want that sort of in writing.
Wow. Thanks for bringing it back to all things Hollywood that you cover as well, Chris Palmieri. Brilliant breakdown of what's happening with Disney. And let's talk a little bit more about how AI is upending the way in which people are thinking about investing in tech and otherwise at the moment. Pleased to just dive into the markets a little bit more with Sylvia Jablonski. She's Defiance ETF CEO, CIO, overseeing, $900 million in assets under management. And some of your ETFs really catering to the focus on AI at the moment, Sylvia. And do you worry that there's hype priced in, or are we underestimating the amount of change and the amount of, value that can be found?
Oh, good morning. Great to be here with you today. Well, I think that I think that the rise in the stock price this year is perhaps on some exuberance over AI, but don't forget that 2022 was very much a tech recession year. So I think a lot of that is catch up. And then the inertia behind the AI build out is something that, helped propel gains. But I do think it's underestimated. I do think that tech has a long way to go. And, with that comes some other components of tech, like semiconductor companies, for example. AI is just beginning, and it's been around for a couple of decades, but it is now just sort of coming to fruition and becoming monetizable. So if you think about what AI can change, it's pretty much every sector out there, everything from healthcare, robotics, surgery, research, to defense, precise information, targeting things like that, banks, accurate credit risk, preventing SVB types of crises. So we're just at the beginning of what is going to be a major innovation in the way that we use technology for the next decade to come.
It was interesting, Ed, yesterday when we had Scale AI on, and he was saying there's a lot of AI tourists, is what he's calling them, not much actually being applied in the market right here, right now. But Ed, are you thinking along the hype or the reality side of things?
Well, I think it's interesting in your case, Sylvia, because Defiance operates the Defiance Quantum ETF, right? Real emphasis on those companies best positioned to take advantage of developments in machine learning and quantum computing. It's not performed as well year to date as the NASDAQ 100, down 30% last year. What within that basket has worked well for you, and what has let you down?
Well, so we kind of look at it a little bit differently. I think what we try to, the way we try to really cater this product and build this product is to give investors access to everything that has to do with the future of technology, machine learning, and artificial intelligence. So in order to do that, you have to include the big generals that are performing well, like the Apples, the Microsofts, IBMs, NVIDIA's on the semiconductor side. And then you also have to include some of the smaller companies like Ambarella, for example, that will be part of the, the visual aspect of it. So there are a lot of things that have to happen in order for AI to work, right? You need to be able to gather data. You need to be able to process data. You need a computer that's fast enough to do it. So that's, that's why it's called quantum, right? Quantum computing and the speed to sort of process and use all of the data is really the key to all of this working, right? And we already hear the criticisms of that AI or, the initial Bard presentation spit out bad data, right? So you need all of that. So what performed badly? Well, high interest rates and small cap growth stocks perform badly. But when they do really, really well is when this innovation truly starts to, transform industries and take off. Interest rates start coming down, and then you get the whole basket performing for you. But the hedge right now are the top leading tech companies that are guiding it forward.
Defiance Quantum ETF up around 12% year to date. I think the NASDAQ 100 is up 22% or something. Single names What are the companies that excite you most and what you just outlined?
Yeah, so I mean, for now, just because of the type of market environment we're in, I'm sort of sensitive to that. So I'll kind of give you the obvious ones. I think Microsoft, I think Google, Apple, Amazon, Nvidia, AMD, On Semiconductor. All of these companies I named first because right now they have balance sheets, they have cash, they can invest in R&D, they can do M&A acquisitions and take over companies. Like in the case of Microsoft, big investment in OpenAI to get ChatGPT going, right? So I think that right now they're the companies that are going to be sort of the performers and this, kind of the safest place to sit. But some of the smaller plays out there, I think, again, like an Umbrella that we just haven't heard about for a really long time, or even a Palantir, you saw them crush earnings. I think these companies are going to start coming to the forefront in the next couple of years as they, kind of improve and exceed expectations with their innovations that they're working on.
And Sylvia, taking a more macro perspective, can those light names outperform even if we see growth continue to even slow down, if we worry that we do hit some sort of recessionary environment? Because the jury seems to be out as to whether tech is some sort of safety play in this environment or whether it is beholden to macroeconomic environments.
Well, I think it's a great question. And I think that all of the, major kind of indices and sectors and the top performing stocks in those sectors are susceptible to what happens in the macro environment. And, that feels like an obvious answer, but it's sort of not. I mean, we have a unique situation now where we have a Fed that has, kept hitting the gas pedal and rising rates and slowing down growth. So there are very few companies that can truly withstand that and come out with, double-digit performance. But we have to believe that we're getting towards the end of that. We saw a PPI number. It looks like inflation is coming down across all sides, CPI, PPI. We're seeing, kind of growth slow. So if the Fed kind of gives us a little bit of relief there, and these companies that have withstood all of this can now actually start to spend and increase and speed up their R&D and rollout, I think it will be a different story. And I think tech will need the market. We need tech, right? We don't have enough people filling jobs. We don't have enough factories that can, kind of meet the supply and demand function out there. We had so many inventory issues. So tech solves all of this. So if anything, the need for tech and increase of spending there is going to increase.
And what about, we talk a lot about the Fed, which is the central bank to the world. What about world stocks? What about, I looked that Quantum has Orange in there, of course, the French company, Airbus. How much are you thinking about positioning yourself globally? Are there winners in Asia as well that you want to be owning?
Yeah, absolutely. And this is very much a global story, right? I mean, it's been, very much discussed that the U.S. is in a race towards artificial intelligence, for example, versus China. So you are going to have some companies in China that are leading the charge there. And you're going to have some companies in the U.S. that are, kind of catching up there. But overall, the idea is to get this global exposure to the top companies that are investing in machine learning, AI, and quantum computing.
All right, thanks to Sylvia Jablonski, CEO and CIO of Defiance ETFs. Good to see you. Now, coming up, all things Google. We'll have more on the news announced at the Google Developers Conference with Liz Reed from Google Search. And we'll hear more from the CEOs of Google Cloud and SAP on their extended partnership. That's coming up next. And actually, I'm checking in on the shares. Biggest jump right now since the first week of February. The stock trading at its highest level since August of last year. We went in saying this was all about search. Actually, what moved the needle on the stock was what they're doing integrating on the software side, workspaces, and of course, a folding Pixel smartphone device. This is Bloomberg.
We take a number of steps to try and increase the factuality of the information. The first that we do is we train our models to actually understand what is the information on the web that corroborates it, that backs up the information. And if we can't corroborate it, then we will not output it.
As in you just won't show it to the user.
Okay?
Yes.
We won't show a piece of information. And if we think a particular query is unsafe, it's harmful, then we will also not provide an AI-powered snapshot.
Liz Reed, Caroline, a 20-year veteran of Google. We wanted to know what search with generative AI looks like. They went on stage and demoed it, and it became really clear what it actually looks like to the consumer.
But What's so interesting about the path that Alphabet and Google are taking is a cautious one. They're almost sort of the antithesis to the way in which Microsoft has folded it in with Bing. They're really aware that this can't go wrong. I thought it was interesting that they're calling it a lab.
Yes. So just like with Bard, they will do a waitlisted, slow rollout for access, testing initially. But we also saw how it relates to docs and sheets and everyday things that people use. And you look at the market reaction, they've really cheered it. So a slow rollout, but substantive evidence of progress. Here's another Google story for you, by the way, Caroline. Yeah. SAP and Google Cloud just announced an extensive expansion of their partnership to make enterprise data more open and valuable and to advance enterprise AI development. I spoke all about that with the Google Cloud CEO, Thomas Kurian, and the SAP CEO, Christian Klein, earlier this week. Have a listen.
Both sales teams can sell the new offering. It will happen, on one paper with one commercial offering. So we actually simplifying it. And actually for us, it was actually very important that it comes with an attractive price, because this has to be a win-win-win situations. Of course, we want to give our customers more reasons to go to SAP and Google. But of course, we also want to offer this new solution at a very attractive price point.
And Thomas, we come to you and ask, how does Google Cloud make money from this arrangement?
Most importantly, I would say, what's the value that customers get out of this? Customers get the value. They can improve their understanding of their end customers. We're helping, for example, Richemont in the luxury industry do that. Customers can improve the way they manage inventory, the work that our two organizations have done at Home Depot. Customers can be more precise in responding. For example, if you're an e-commerce company and you're making commitments to deliver products on time, as we've done with Mercado Libre. Customers can plan better, as our two organizations have helped Vodafone. So the value that we both bring is helping people use their business systems, SAP and Google Cloud, their data, and to transform the way that they serve customers and manage their business. That's what drives value, and that's what brings customers to both of us.
Christian, in the competitive landscape for corporate applications, you look at what Microsoft's done to move early to bring AI into corporate applications. I'm thinking about, of course, Dynamics 365, Copilot as one example. How much of this arrangement is you being conscious of that competitive landscape right now?
Yeah, the good piece is that a lot of partners, especially in AI, they are reaching out to SAP, because I feel a lot of companies have one challenge today. They are buying AI technology, but what about adoption? Now think about it. 80% of the world's transactions are touched by an SAP system. So if you're going to embed machine learning and going forward generative AI in our products, you immediately going to see high adoption, and you immediately unfold a lot of value for the customers in their business processes. And this is why we are so excited about AI and about this partnership, because you also need high quality data to really bring AI to the next level.
And to that point, Thomas, both parties are expressing confidence that Open Data Cloud is going to basically spur innovation in the field of AI. What does that look like?
First of all, we fundamentally believe data is a critical asset for a company. And it's both SAP and Google's joint belief that that should be open, so people can use whatever tools they want to access the data. Second, we are unlocking data and simplifying the use of that data in the context of business processes that large customers have. I mean, the world's largest, most sophisticated companies in virtually every industry run SAP. Many are using Google Cloud. The combination is unlocking how AI is applied every day. Think about a merchandising manager in e-commerce trying to figure out how much inventory of what product do I maintain in what location? A supply chain manager trying to figure out where do I need to put capacity in which country? Every one of those customers and many more will be able to use our joint solution to open up how AI is going to help them every day in their day-to-day work.
Well, on that note, Thomas, are there any specific verticals where you expect this relationship with SAP to help you do better than AWS and Azure?
Well, we have very strong partnerships in many verticals: manufacturing, automotive, retail, healthcare, supply chain and logistics. These are all different industries in which we work very closely with the SAP team. They're a super strategic partner with us, not just in how we bring solutions to customers, but also in the deep engineering collaboration. And every step as we evolve our offerings together, we think it'll bring value and competitive differentiation.
Just a brilliant interview and really assessing how this is going to impact enterprise. Google Cloud CEO there, as well as the SAP CEO. Ed.
Yeah, it was an interesting one to conduct as well between two big name CEOs. Now, coming up, Microsoft buckling down on the cost during a time of mounting economic uncertainty. More on the changes to workers' salaries coming up next. Caro.
And this is an interesting one. Another company we're watching, it's Chinese company JD.com, e-commerce giant. Look, it just announced that its relatively recent CEO is actually going to be retiring already, although a long-term person at the business, handing over the reins to a female CFO, as this is a company that is struggling with a focus on profitability at this moment. Shares spiking up more than 3%. Quarter sales earnings actually did beat analyst estimates. It's a slowdown, but they managed to beat what the street had anticipated. From New York, from San Francisco, this is Bloomberg. It's time now for Talking Tech. First up, Hon Hai reported its third straight quarterly profit miss. Look, it's the company that's the main assembler for most of Apple's signature devices. It's a rebound in the iPhone sales last quarter just failed to offset the weakness in the overall smartphone market. Meanwhile, SoftBank's Vision Fund, look, it's been losing money again. That's despite the rebound in tech stocks here in the United States. The unit lost about $2 billion in March, from March even, and its investments in startups in particular, the private companies, fallen about 90% during the year. Meanwhile, though, the firm's ARM unit, that posted some record revenue on a quarterly basis, but some mixed results. That's as SoftBank prepares to take that chip designer public. Plus, Microsoft is freezing pay for all full-time workers this year for what it says to help navigate macroeconomic uncertainty. However, it will consider raising rates for hourly workers. It's the latest US tech leader to really tighten its belt for investments in other areas, Ed.
Yeah, we're going to go to Disney next. I'm looking at the shares down the most since November. Subscriber miss, widening loss. We've got to get to that conversation. This is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. News, data, earnings. We better get a check-in on these markets when it comes to the technology sector. Actually, the NASDAQ 100 slightly outperforming, up 0.3% relative to a slightly down market. But there's underperformance in chip stocks. A part of that, some names giving up recent gains, some moving to the downside, maybe some repositioning on who the leading horse is in the AI race. Interesting as well to look at the yield on US 10-year, softer by around 6.5 basis points, 7 basis points, 3.37%. Bitcoin as well. We're going back towards $27,000 per token. That was a level we were at the end of March. We've lost some momentum when it comes to the biggest cryptocurrency by market cap. In the equity markets, there is one clear mover to the downside, and that is Disney, dropping by the most since November. A subscriber miss and looking at a widening loss, which the company describes as a blip. It's all streaming, Caro. The story is streaming. No matter how much we wanted to talk about parks and whether this is a tech company or a media and entertainment company, we are talking about streaming.
And let's talk about the tech angle with none other than Rich Greenfield. He's in the house here in New York, Lightshed Partners, of course. I mean, you said it. We made it in to talk about this today because you don't often see a juggernaut like this move 8% to the downside.
This is a pretty big move for Disney, and I think you're seeing sort of the whole media sector is under a lot of pressure. And it's because the traditional, the core business of many of these media companies are broadcast and cable networks. And you're just seeing those businesses really, really struggle. I mean, Cord cutting is accelerating. You're seeing that from all of the major players, whether that's Comcast or Charter. You've seen it with Dish. You're just seeing a real acceleration in cord cutting, meaning high single digits. You're seeing companies like Comcast have double-digit declines in their video subscriber businesses. That's having a real impact on companies like Disney. You saw it at Paramount last week with a huge move to the downside, and Paramount forced them to cut their dividend. All of these companies are struggling with what is the future. Because remember, streaming, they're losing money.
Yeah.
They're cutting the losses, as you just profiled, which is good, but their core businesses are facing more and more headwinds where revenues, both subscription revenue and advertising revenue, are going down, and their cost structures are going up, and their only choice is to massively cut costs. And that's what you're seeing across the board in media now.
Or indeed charge us more when we do get addicted to certain subscriptions. The overall view of Disney Plus is charge them for it or get good advertising.
I think Disney Plus is very similar to what you're seeing out of Warner Brothers Discovery, WBD. You're seeing similar strategies of both companies wanted to be Netflix. Like their goal was to take on and be Netflix, meaning a little bit of something for everyone. It was not just HBO within HBO Max, now called Max. I think with Disney, they were trying to be a little bit of everything, really broaden out the programming. And I think what you're seeing now is really a contraction back to what their core is. HBO is really centering back on HBO. Disney is sort of saying, we're going to cut $1.5 billion of content out of the pipeline, as well as on the service itself. They just aren't equipped, really financially, to go compete at the level of what Netflix is trying to do globally. I think it's actually a very, very bullish sign for anyone looking at this space. You should be buying Netflix this morning. I mean, that is the clear takeaway, is that Netflix is increasingly, quote unquote, one.
Rich, consolidation of platforms, the combination of Hulu and Disney Plus. This is what Bob Iger had to say. There seems to be real value in having general entertainment combined with Disney Plus. And if ultimately Hulu is that solution, we're bullish about that. Are you bullish about that?
Well, it's really interesting, honestly, because, Ed, just a few months ago, Iger was talking about how general entertainment was undifferentiated, sort of calling into question the future of Hulu. They had retained an investment bank to look at selling Hulu. My guess is they couldn't find a buyer for Hulu, and they realized that they really have no choice other than to absorb it. And so I think, and they're also looking at Disney Plus slowing, and so they're looking at broadening the content out. But remember, what they announced last night is not really a combination of Disney Plus and Hulu. If you subscribe to both, you'll see a Hulu tile inside of Disney Plus. You won't even get all of the content that's on Hulu inside of that Disney Plus tile. You'll have to go to the Hulu app for all of the content. But it really, I think, the key trigger is this essentially is a sign to Wall Street and to the broader media industry. Disney knows they're going to be buying Hulu. It's probably going to cost them at a minimum $9 billion, but probably $10, $11, $12, or $13 billion to buy Comcast out of their Hulu stake. And I think that's also adding to the pressure on Disney stock because it's another financial burden that's coming over the course of the next 12 or 18 months.
Rich, our Star Wars fans out there in the audience will notice that going into May the 4th, there were in-platform and out-platform ads about all of the content that was coming relating to that May the 4th be with you date. Was that the shifting marketing costs that the CFO blamed a widening loss on?
I think one of the big questions for Disney, this is broader than just your question on Star Wars, a lot of the core franchises have not been firing on all cylinders. I mean, look, even Guardians of the Galaxy, very well reviewed. Third film is clearly doing worse than the second film. There is really questions, you saw it with Black Panther, like Disney's having trouble both in their sort of live action filmmaking with their major franchises, as well as animation. I mean, animation is probably the story no one's talking enough about. I mean, last night on the call, Bob Iger congratulated Universal, a competitor, on their animation success with Super Mario. The lifeblood of Disney is animation. And Ed, think about what was the last Disney animated movie that people were really excited about? It's been years now, and they're really getting beaten to the punch day after day by Universal. And I think it's a problem for Disney, and I think it's what Iger, I think more than anything, Iger is slowing down production, focusing on quality over quantity. So it's absolutely the right decision for Iger to do. The problem is it's not a quick fix. Last time when he came in originally to Disney, the very first time, what did he do? What was his quick fix? Was buying Pixar. There's no quick fix. It takes years to turn around animation. and even just content more broadly. You don't just change your movie schedule overnight. And so this is, I think, sort of what you're seeing in terms of investors.
Yes.
They're becoming aware that the fix for Disney is going to take time.
Fantasia 1940, to answer your question. Caroline, what Disney faces is problems in common with the rest of the industry, one of them being a writer's strike in Hollywood.
Yeah, and to that end, costly labour at a time where they need people to be writing. Just, Rich, how much is that? Obviously, we're seeing overall people worrying about writer's strike, about the cost of labour, about trying to trim down. Is this something that affects Disney in particular, that we spoke about it on the...
Well, I think you should think about all of these companies are losing, leave off Netflix, which is making billions in, EBITDA and free cash flow. But all of the other legacy media companies, whether it's Disney or Paramount or Comcast, NBC, Universal, they're losing not a billion, they're losing billions on streaming. So anything that slows production is actually in the short term financially on a cash basis is actually good for them, meaning they will lose less money this year because of a long writer's strike. That's sort of perverse, but that's essentially what's actually good for these companies on a cash basis. The problem is, and I think this is the obvious one, a long writer's strike clearly is going to impact linear television come the fall. Like, you may not see a lot of your favorite shows on air because you need writers for these shows on linear TV. For people that are still watching linear TV, and yes, it's shrunk a lot, but it's still a pretty big business for these companies financially. And so that's going to have an impact. Plus, if the strike goes on long enough, meaning the fall, September, October, then you start to impact how much content is on these streaming services. And that could also be a problem for these companies in terms of keeping subscribers. You saw people were clearly frustrated with Disney losing subscribers.
Yeah.
Not a big number in the US, but lost a little bit of their subscriber base last night. That's something they haven't sort of seen from Disney in the past.
There are more immediate headline-grabbing lines for us to focus on with Disney today, but AI did get its way in there a bit, and it feeds into the writer's strike and what they're worried about at the moment. Is AI in any way going to help hinder Disney, do you think? Is it something to be talking about?
Look, I think AI as a category is something that can help production. Obviously, there's ways that it can speed production. Certainly, if you think about what you can do with it creatively. I actually think for most of the media industry, I think AI is certainly a risk in the short term, not because of piracy. I actually think about what the greatest risk of AI right now is. Imagine the quality of content on YouTube, on TikTok, on Instagram Reels. The better that content, we're in a war for time.
Yeah.
If you think about everything as a war for time, if all of a sudden the content that some random person can create on their own and put up on TikTok or create their own newscast, whatever it may be, like, all of that creates competition for eyeballs. And I think when you're talking about advertising, you're already seeing the impact that things like Netflix are having on taking ad dollars away from traditional media. I mean, next week's the big TV up front. Now imagine the quality of sort of user-generated content getting meaningfully better.
Well, Rich.
That's what I'd be worried about.
Let's go back then to our question of the day, which is Disney a technology company, or is it just simply a media and entertainment company? Very quickly.
I would say it's neither. Disney's an IP company. They're probably the best historically at creating IP and monetizing it through the flywheel of all of Disney's engines. The challenge is their IP hasn't been as good. And the reason you're seeing, look at what happened with their consumer products business last night, down dramatically year over year. I think the creative engines of Disney, not are bad. Certainly, I think a lot of other companies would love to have Disney struggles, right? Because their struggles are still better than a lot of other companies. But relative to where Disney's been over the last 5 years, certainly if you think about Iger's first run, where he sort of, went off into the sunset with this incredible run in 2019, Disney is certainly not firing at that level creatively that they were back in 19. And I think that's what investors are concerned about and looking for them to turn around.
All right, Rich Greenfield, Lightshed Partners, thank you very much for your time.
Thanks for having me.
Caroline.
Still psyched about seeing Little Mermaid. Meanwhile, coming up, the impact of China-US relations on tech, investing in the US and abroad. We're going to discuss it all. Mitchell Green from Lead Edge Capital is going to be next. Also, look, we want to keep a close eye on what's happening in the world of banking. PacWest, it does indeed lend to areas in SF, and deposits falling 9.5% last week after we reported that the lender was in talks with potential investors. Look, the anxiety around the US banking system is still fresh. This is Bloomberg.
America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability, and we have differences. We're capitalists, they're not, and it's okay. We could sort that out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic economic relationships, including trade.
That was JP Morgan Chase CEO Jamie Dimon there, talking about the global landscape in the context of rising tensions between China and the US. This comment comes as US National Security Advisor Jake Sullivan sat down with China's top diplomat Wang Yi in Vienna earlier today, as the White House is seeking to keep relations from getting worse. That according to a US official. I want to go deeper on China in today's VC Spotlight with Mitchell Green, CEO of Lead Edge Capital, $5 billion in assets under management. You are a VC who has been bullish on China. When you hear Jamie Dimon and the news flow of the day, do you remain bullish on China?
Yeah, I think long term, we are bullish. Predicting that. Thanks so much for having me on, by the way. I think long term, we definitely are bullish. Near term, I think it'll be bumpy. It's continuing to be bumpy. But I think we would also, look, I'm not going to come on here and pontificate about the, macro and, foreign relations with, countries around the world. That's pretty much the last thing we are experts on. But I do think an open dialogue between our countries, and I think it is important that both countries realize that both of us need each other. And, a military conflict would be absolutely horrible for both countries.
You were an investor pre-IPO in Alibaba, and there is a debate, at least in the conversations that I'm having out here in Silicon Valley, in your industry, about not just whether you should put capital into Chinese domiciled startups, but if you should take money from China-based LPs. Where do you sit in that debate?
We would definitely be willing to take capital from. We do not have any. Actually, I take it back. We have one Asian LP, but we would take additional capital. Like our companies, which are primarily North American, Europe-based. But we're investors in Alibaba, and we have an investment in ByteDance and Ant Financial. Just like we want to have in our next fund, which we'll raise in a few years, we want to have more Middle Eastern LPs. I would see nothing wrong with adding Chinese LPs or Korean LPs and things like that. There are some challenges in some of these other countries in Asia with getting money out of the country, so they need to have been they need to have the right structures in place. But I have nothing philosophically against it at all. Probably the opposite. I'd love to have.
Mitchell, what about just the ecosystem in which we build here in the US, or indeed in Asia or Europe? Are the regulatory building blocks being built fast enough or with indeed enough focus and knowledge behind them? We think about crypto startups being frustrated. We think about AI startups looking for leadership when it comes to the guardrails already in place. Do you feel that we've got that safely in the US to thrive in the startup scene?
I think that what's interesting is that regulation in China happens extremely fast. And it's decisions are made by a very small group of people and made very quickly. The largest tech companies in the United States, sure hold a lot of market power and can dictate which companies, fail and succeed, and what companies pay. And small companies, they can make it. They can make distribution. Distribution is very tight nowadays. In terms of, there's only a handful of big internet companies that all smaller companies need to try to get distribution through to grow. The Chinese government just put a kibosh on it with Tencent and Alibaba, just decided this wasn't a 10-year debate, which is going to happen in the United States. There is a lot more regulation that is needed around all this cryptocurrencies. We're pretty bearish on a lot of these things. I think they're here to stay, but I think some of these don't really have real use cases, where I think the Chinese have done actually a pretty good job with a lot of the regulatory things. AI is going to open up a whole new can of worms. My guess is they will figure out how to, I joke, China is run like a corporation. The U.S., I just invite you to watch congressional hearings about Facebook and TikTok, and it is quite amazing. And I think we have I think it's going to take a while for regulatory frameworks to come into place, given the lack of knowledge, it appears, of people in Washington.
So despite that lack of AI regulation as it stands, are you backing founders coming to you at the moment looking to build in the artificial intelligence space? What do you make of the rate at which companies are sort of dubbing themselves an AI business?
So all these hype cycles like come and go, right? Remember a few years ago, everybody said we'd have self-driving cars and taxis and Ubers and everything would disappear. Pretty sure I still drive to the office, and I bet you do as well. AI is going to change the world. Like if you call a Delta Airlines call center, there's no reason you should sit on hold for 45 minutes to just get somebody who probably has to get somebody else to help you. 95% of that can be solved through the computers. Coding is going to dramatically change. Email, all these things are going to change.
Okay.
It's just going to take longer than people think. But absolutely, like we're in business for it. A lot of these companies are still quite small, and we tend to invest in companies with 10 million to 200 million of revenues. But absolutely, I mean, Bessemer just announced they're going to put, Bessemer Venture Partners just announced they want to put $1 billion into startups in the space.
Mitchell, given the size of your target companies, I want to ask you about venture debt. Bloomberg writing about the data this morning that venture debt has gone from record levels last year to 2017 levels in the first quarter of this year. How closely do you track that?
You could have said the same thing for venture financing too. Look, we've lost in, not long ago, and I don't know if it was late March, early April, like Silicon Valley Bank was a major provider of venture debt. Obviously, the shell exists, but it's been acquired, so we'll see. But as venture financing is down, venture debt will also be down. These things come in cycles. Like I think it's frankly like if you liked investing in software, internet, AI, growth businesses, healthcare businesses in 2019 and 2020. You sure should, just like if you liked them in 2006 and 2007, the way you made a lot of money was doing it in 2009 and 2010. Like we think the next couple of years will be some of the best vintages in growth equity and venture over the next, just because the best time to invest is in a recession.
Keeping on being persistent. Mitchell Green, we thank you so much, CEO of Lead Edge Capital there. Meanwhile, coming up, massive recall of more than 2 million Peloton exercise bikes. More on the safety hazards they pose and what actually that means for the company right now. This is Bloomberg. Time now, what's going viral? Shares of Peloton falling the lowest point in almost 7 months. That's after the fitness company recalled, get this, 2.2 million bikes due to a safety hazard with the seat. Mark Gurman, break it down for us. Again, another knock.
Yeah, thank you as always for having me. This is the fourth recall in the history of Peloton, right? This is less significant than the treadmill Peloton recall a couple years ago where people actually died because of the device. This is an issue with the seat post on the bike. So that is the metal part that attaches the seat, sort of the saddle on the bike that you sit on while using it, to the actual core frame of the bike. And in some cases, the weld joint, that area could break off and you could fall off the bike. There have been a few dozen cases. There have been a few injuries. Some bruises are mentioned. The most significant injury that was mentioned is a fractured wrist. Obviously, none of that is good. Peloton and the U.S. Commission that handles product safety today announced the recall, 2.2 million units in the U.S. and Canada. They're offering an at-home fix, a replacement part, and a video for you to replace it yourself. But as of now, if you have an impacted bike, these are the original bikes, they're recommending you stop using it until the fix is installed.
Right, and it doesn't impact owners in the UK, Germany, or Australia. Our thanks to Bloomberg's Mark Gurman. All right, so that does it for this edition of Bloomberg Technology, Caroline.
Yeah, you do not want to forget about our podcast, though. Catch up on all of it on the terminal, online on Apple, Spotify, iHeart. From New York, from San Francisco, this is Bloomberg.